Hello and welcome to a brand new show of Market Makers. Election fever now is in full swing. With less than 3 weeks left for the election verdict, how should one read into the recent price action? Despair has become euphoria, but is it a matter of time reality would kick in? How should one map into and read into valuations, and how exactly is the risk-reward ratio stacked up? To understand that and to get a better understanding of the current setup, I have with me on this edition of Market Makers a very special guest, Sunil Singhania, CIO-Equities with Reliance MF. What a delight to have you back on ET. Thank you for joining us. Characterize the market environment for us. 3 months ago it was despair. Now there is a tinge of euphoria.
I think, there is definitely optimism, and I won't call it euphoria for sure. But it's a welcome change from what we were seeing over the last 1.5 years in particular, where things were looking difficult, both from the international as well as domestic side. So I think it's a welcome change, and I'm very sure no one would complain about it.
It's a welcome change, but is the change here to stay is the big question. Are markets running slightly ahead of themselves?
See, no one can predict the market for sure, but our view is that we are heading into a scenario and heading into a period where definitely optimism is the call. And it's not only about elections, but I think even if you look at the global markets, even if you look at the fundamentals, I think from India's perspective, we have seen probably the worst. And India stands out both in terms of improving fundamentals, also in terms of fund flows. And we also have an additional kicker in terms of, a new government coming in place. And we hope that it will be a stable government irrespective of the party. So I think looking at all this, we definitely are optimistic.
But what happens if some of the key assumptions are challenged, and they could get challenged? Election is a different kettle of fish, very difficult for anyone to predict. What we can understand and analyze are the macro indicators and the earning estimates. The macro has not bottomed out, earning has not kicked in, and valuations are looking slightly stretched.
See, I'll differ on this point. If you actually see March 13 and then see March 14, you see current account deficit, it was 5%. Now it is below 1%. Inflation was upwards of 10%. Yes, we had a little bit of a negative surprise this week when the inflation numbers came in. But very clearly, inflation is heading downwards, and we have already seen the WPI much below 6%. You have a fiscal deficit which everyone was doubting will be at least over 5%. We have fiscal deficit which was contained at 4.6%. And going forward with this, diesel and petrol prices being increased, we are looking at a scenario where fiscal deficit might be even lower next year. As far as earnings are concerned, December was the first quarter where corporate earnings in fact surprised marginally on the upside as far as analyst expectations were concerned. So, even there, we believe from here on things can gradually improve. And I think most important thing is the world is a much better place. The currency from 68 has, bounced back to around 60, and where it is very, very stable. Fund flows towards equities, towards emerging markets have, renewed, which again is a welcome change. We have already seen over 25,000 crores come into the Indian equity markets in the first 3.5 months. And, we have the renewed optimism as far as outlook on a lot of sectors is concerned. Elections can be an additional trigger, and we have seen in the past, irrespective of which party comes in, the first year after elections are normally very good for both the economy and for the markets. So I think from our perspective, definitely good days seem to continue going forward.
So you're having this glass half full approach. Let's go with the glass half full approach. I buy an argument that things are looking strong. But how much of the good news or incremental upside is already in the price? Because Nifty is at 6,700. Sensex is well above 20,000. We've seen a one-way rally in momentum stocks and in some banks. So some would argue that the rate of change is favorable, but maybe all the good news is in the price.
I think unfortunately, Nikunj, we get too fixated with what has happened over the last 3-4 months. You said that the index is moved up to 6,700. I mentioned a lot of factors which have turned positive over the last 1 year. But in the last 1 year, index is up only 10-11%. So despite such dramatic change in the macroeconomic and the environment, index is up only 10-11%, which is lower than the earnings growth which we have seen over the last 1 year. So in fact, it's underperforming the earnings growth. I think secondly is, we have seen the economy almost double since the last time index touched over 6,000 to now. And the index is up only 10-11%. So though the size of the economy is almost doubled, index has not kept pace. And normally index keeps pace with the growth in the economy and the growth in the profitability. So I think we should get away with this fixation of an all-time high or what has happened over the last 3-4 months and look what can possibly happen going forward. One thing I would like to mention here, and you have been also asking me negative questions. Most of the investors keep on asking, what if this happens, what if this happens, all pertaining to the negatives which can happen to the market. No one even asks what positives can happen to the market. And once you start to analyze that, we do believe that surprises on the upsides are more likely than on the downside.
So why don't you tell me what positives could happen?
No, we have not seen, any analyst expecting more than 10-12% growth in the earnings. We are all fixated with the fact that GDP has fallen to 5%, Why can't it again go back to 7-8%, I think India has all the potential. We on the grassroots levels are looking at the potential of so many sectors. So that is a possible upside. We are also in a situation where, interest rates are at a high. I think nowhere in the world is the central bank having the luxury of cutting interest rate for 10-12 times. Because in India, the interest rate reduction cycle has not even started. So it might take some time, it might take a quarter or two. But the trend is very clear that ultimately interest rates are going to fall. So I think across, factors, yes, the near term poses a little bit of challenge. But once the cycle starts to decisively turn on the positive, you have multiple times when interest rates can be cut and when a lot of other factors can take into place.
Right. So I may sound slightly repetitive with this one, but just for the benefit of our viewers who are watching the show. At the current juncture, your house view is that there is no froth in the system and markets are not overextended.
So always in markets there will be some sectors, some stocks where there will always be a little bit of more over-optimism and somewhere where there will be pessimism. I think this is the style and this is the way the markets behave. So, you can't generalize. But overall in the market there is a froth. We don't think so. If you actually look at the domestics, the domestics have been continuously selling. Yeah. That means the retailers have been completely out of the market. And, markets froth never happen without a massive retail participation, and we have not even seen the start of the retail participation. The second thing is, on a PE basis also, if you take FY16, which is 1 year forward, we are trading somewhere in the region of 14 times. I don't think in any part of the world, a PE of 14 would be classified as a froth. So we don't agree with that philosophy of froth. Having said that, whether there can be a little bit of reaction based on some news flow, I think that is again a part and parcel of the market, and that can always happen.
I think the new bull market has started because technically there are all the right indicators. The markets are falling less. We are way above the previous high. Fundamentally, do you think a bull market has started?
See, I personally and we as Reliance Mutual Fund are optimistic on the Indian economy. And we do believe that India has the potential to be a $5 to $6 trillion economy in the next 6-7 years. So I think what we achieved in 60 years after independence, where we reached
theory. That's theory.
No, it's not theory, it's actual. You see your income, you see my income. The kind of salaries which were prevalent 10, 15 years back and today, there's a seesaw difference. And the markets has to reflect all of these, So whether it's the salaries of an individual, whether it's the GDP of the economy, and it's not theory. So if the GDP becomes $5-6 trillion, it is not incomprehensible to expect the market cap of India to be $5-6 trillion, which is right now $1.3-1.4 trillion. So, theories do work because these are time and tested theories over 100-200 years in other parts of the world. So I think, we have a lot of potential.
Okay. So let's assume that a new bull market has started. It's all about participating. It is all about investing. Every bull market has a new horse. Courses remain the same, horses they change. So what are you betting on with the assumption that we could be staring at substantial growth?
See, very clearly, the way the markets are behaving, if we have a stable government, obviously the first thing to move would be the domestic economy related stocks. Also, you can say amplified with the fact that rupee has been appreciating a little bit, continuously. So if you have a rupee appreciation again slightly, then you might have the old favorites, which is IT and pharma, underperform for the near term, and the high beta, which would be the capex and the financials, perform, in the near term.
But we've seen that delinking already happened.
To some extent, yes. People talk about banks, but if you see the 1 year performance of banks, there are so many banks which are on a 1 year basis are still negative or hardly positive. We see the last 3 months and we get very, you can say overjoyed with the fact that some banks have gone up by 30, 40, 50%. But these are the banks which fell also very, very sharply. So I think to have a holistic picture and a more rational picture, we have to look at what has happened over the last 1 year. And that is what I started with, that March 13 to March 14, things have changed dramatically. The index is up only 10-11%. And I think that is the bottom line which you have to look at. Having said that, I think, India is a great country. We are an entrepreneurial-driven country. To some extent, we are like the US, where entrepreneurship is driving businesses and entrepreneurship is driving, the industrial output and the services growth. And there you see so many opportunities which are coming in, So internet, you have new listed companies which are coming up, homegrown brands, which is again a very, very large sort of coming theme. We have discussed about the liquor sector earlier. We continue to like that. So there will always be pockets. And there are a lot of, you can say, engineering companies which are trading at, multiples which are much lower than their historic multiples. If you sort of, rationalize or average their performance, what we are trying to do is take their last reported profit and calculate the PE and EBITDA on that basis. However, the last 1 or 2 years were not natural periods. There were periods, where interest rates were high. There was, to some extent, policy paralysis. There was also significant pressure on the company, so there was no capex. And, you can't take that as a normalized kind of, results. What we have done is, we took all the companies, took their last 7 years profit numbers, and the maximum profit they made in the last 7 years. We just have to see whether the company can replicate that in the next 3-4 years. And then take the PE based on that.
So you think engineering companies can replicate, banks can replicate that?
Definitely, definitely.
So these are two sectoral
But you need good quality balance sheets, good quality companies with some technology. And I think that is where we are focusing on.
Okay. Liquor, your exposure to United Spirits, it's been a multi-bagger for you. Congratulations on identifying that stock. Diageo is offering a decent price, 3,000 rupees per share. As an institutional shareholder, are you tempted to tender your shares?
See, I can't discuss stock-specific, stories or even what we are going to do. I think what I can basically just comment is that, with almost 15% of the world's population, a company owns 50% market share. So technically, you own 7.5% of the global market share. And you're getting the stock at like $5-6 billion, or the whole sector at like $7-8 billion. So, this, according to us, it's a great structural sort of a theme. I'm talking on the spirit sector. However, near term, what is going to happen, what is not going to happen is anyone's guess. But structurally, we believe that this is the best FMCG play as a sector or sub-sector to play for.
If your view is that the rate of change is going to be more favorable for economy-related sectors, you run a portfolio which has a decent exposure to IT. In fact, your top 3 holdings are from large-cap IT. So what's the rationale behind that?
See, we are not overweight IT. We might be slightly overweight IT, but we continue to be positive on IT, largely because of the fact that the world is also a much better place. The demand for IT, which was suppressed over the last 3-4 years, particularly in Euro region, is coming back. And if you actually now see the way business is done, every company needs to have a digital and an IT strategy. So the spending on IT is only going to increase. You have more and more retailers going online. You have more and more businesses going online. You have suppliers going online. You have buyers going online. So the demand for IT is only going to increase. And you are getting stocks which are not expensive. You're getting it like 12p, 13p, 14p, and these are large companies which are making $1 billion of profit.
So large cap IT is still cheap?
We definitely believe that it is attractive. Having said that, near term, based on the near term rupee movement and also the fact that domestic investors, institutional investors are not getting fresh inflows, you have to use the same pool of money to churn your portfolio. So if I want to buy something on the capex side, I need to sell something. So I think it's a near-term rebalancing of the portfolio, which is probably causing the prices to move the way they are. But we continue to like the sector from a very, good, stable, decent return profile. And that would be applicable even to the pharma sector.
You run a pretty diversified portfolio. You don't take big sectoral bets, but, within sectors, sometimes you go overweight, underweight. So what's your large, big overweight position?
So it's, frankly, as a fund house, as I said, we are overweight definitely on the auto as well as the capital goods side. Auto, because it's a way to play the financials. and we have tried to play the financials through the auto, which has worked pretty well. We have definitely inched up our exposure to the banking sector in the last 1 month.
Just a trading call.
It's you can say you can call it a strategic call, because some of these stocks are purely you can say from a trading perspective. But by and large, we do believe that there are pockets in the banking sector which will start to do well as far as equity markets are concerned once risk appetite increases.
Last time when we interacted with you on this forum, your big call was to buy into media. Is that call still valid? I don't see too many media stocks in your portfolio.
No, we continue to be very positive on media, and it's election time, so nowadays more time is spent in front of the TV. But apart from that, you go to any country, after food, clothing and shelter, the fourth thing you spend upon is entertainment of all kinds. So whether it is eating out, or whether it is watching movies, or watching TV, or listening to radio. So we continue to be very, very positive. India is going through a lot of structural changes as far as the media sector is concerned. The way content is disseminated, the way collection is made. Even on the exhibition side, on cinema, you now have multiplexes sprouting everywhere. So the experience is changing. And our view is that if internationally, media sector can be 5-6% of the total market cap, in India also, time is not far where it can be, probably more, because we are growing faster. So we continue to be quite positive on the media side. So and we do have a lot of media shares.
But you believe on the entire supply chain, broadcasters, multiplex owners, content creators. So you're betting on the entire supply chain.
Yeah,
entire media chain.
Definitely. But again, there are some pockets of media sector which are more stable, and there will be obviously some pockets of on the media side which will be a little bit more volatile.
More light on that?
Like film making companies will have more volatility. Okay. A distribution company or a TV channel would have less volatility. Okay. The rates of growth, say in a newspaper company, the rate of growth might be slightly lower. An internet media company, the rate of growth might be slightly higher. So you'll have to balance it based on the valuation as well as the growth rates.
Has consumer staples corrected enough? That was your big call. You went underweight consumer staples, I think, in 2012. That call sort of hurted you in the short term, but the long-term benefits are visible now. But enough time-wise correction, do you think, has already happened in staples?
See, again, the growth rate has to match with your expectations of, which is calculated by way of perception of the PE ratio. I think somewhere down the line, the PE ratios had moved away much ahead of the growth rates. Yeah. And unfortunately for the sector, last 1 year has not been particularly good as far as the consumption demand is concerned because of high inflation. Our view is that it's a great sector as far as investment is concerned. India is underpenetrated across FMCG, sort of goods. But again, you have to be very clear what are you playing for. So if it's just an allocation game, then you're better off buying any large FMCG company. But if you are actually playing for growth, then you will have to pick niche plays. So as I said, spirits is one subsector among the, you can say, the complete FMCG basket. Anything to do with feminine hygiene is a big subsector which we feel. Homegrown brands, again, consumption side, we believe that there is a lot of opportunity. Internet, anything to do with e-commerce might, again, open up a lot of these kind of opportunities. So you have to be now very, very selective.
Walk us through the benefits of long-term investing, and this is something what I want our viewers to understand. I mean, 100 rupees put in Reliance Banking Fund 11 years ago has become 11x?
Yeah, 11x, that's what our ad says, 11x in less than 11 years. See, what happens, typically investors get fixated by what has happened in the immediate near past. So I'll give an example. In 2003, no one wanted to buy gold, because previous 10 years history of gold was very, very negative. The same was the case with real estate. I think equities has gone through that phase where we had rapid growth in returns, massive returns were made, and the last 3-4 years returns have been very, very muted. And unfortunately, as a fund manager, you have to manage the near term as well as the long term. But time and again, it has been proven that if you have conviction in what you're doing, if you have conviction in the economy, and if you have conviction in the people who are managing your money, you see the same faces, so that conviction increases. You definitely make returns. So 11x in 11 is almost 20 to 23% CAGR.
Tax-free.
Right. And some of our other funds like Growth have almost become 52 times in the last 17-18 years. These numbers look big, But if you actually see on a compounding basis, it's 20-22%, which is much more digestible. But the law of compounding and the benefits of compounding keeps on playing. So I think from an individual investor's perspective, very clearly, don't bother too much about whether you are 1% higher or 1% lower on a daily basis. Just have conviction in your asset class, have conviction in the country, which is very, very important, and then have conviction in your asset manager. And these kind of numbers will keep on coming as long as the country grows.
So don't look at the fact sheet, don't look at who's in the top quartile, who's in the bottom quartile.
No, you have to look at the fact sheet so that you keep us in check if we, go astray a bit. But have focus on creating wealth rather than near-term income. So, the choice is very clear, whether you want income or wealth. If you want income, then look at the NAVs and the stock prices on a day-to-day basis. Watch your 9 o'clock show of hits and misses. And if you want to create wealth, then, just invest and forget about it.
So if I have to summarize our today's interaction, your basic appeal or message to millions of unit holders and our viewers is, this is just the beginning of the good times. Even though run-up looks big on paper, the upside for equities as an asset class is still there.
Now, I would like to give another message, I always ask this question to investors, that how many of you all have 500 shares of the top Indian companies, whether it is Infosys or TCS or HDFC Bank or ICICI Bank. And in a group of 500 people, I get 1 or 2 people who raise their hands. So I think the irony of our country is that we stay in the country, we are positive on the country, we are making enough wealth in the country. In fact, India is the only country where 99.99% of the people's net wealth is at the highest level ever. No country in the world will have that statistics. Our net wealth is much higher than what it was in 2009 or 2003 or any other period. But despite that, the allocation to equity is falling. So, we have sold all our equity to the foreigners because we get worried about what is happening in India. We get worried about what is happening in Italy or Cyprus or Dubai or Indonesia or Crimea or Ukraine. We get worried by fiscal cliff. We get worried by QE tapering.
Knowledge of geography has really increased in the last 3 years.
We have 50 channels and we have 5,000 experts like us who come every day. So people are over-informed. And that sways the near-term decision. And as a result of which, all our good shares have been sold. The ownership in Indian stocks from retail investors is down to like 6-7%. Foreigners now own some 350-400 billions worth of stock. In fact, there is hardly any room for foreigners to buy Indian stocks. There is some $80-90 billion worth of stock left. That's it. So I think you'll have a situation where 10 years down the line, if this growth continues, you might look at some fund, in the industry being 100 times. And that would really start to hurt.
So it's time really to test waters and take a dive. Okay. So we really appreciate your time. Always fantastic to have you back on ET.
Thank you.
That's it on this edition of Market Makers. I'm Nikunj Dalmar signing off. Thank you for watching the show.